Hi everyone, here's my update for March 16th, 2026. The market buffer is gone, get ready for a volatile week. Part 1, the central bank disconnect and the rearview mirror. So this week is going to be packed. We have 6 major central banks meeting to decide on interest rates in just 3 days. So I put Monday, Tuesday, because basically, depending on your time, it could be either tonight or tomorrow, but the Bank of Australia will be the first one to do the decision, and they might be hiking from what I've seen. On Wednesday, we will have the US Federal Reserve as well as the Bank of Canada. And the Federal Reserve will also provide the economic projection that they don't do every single meeting. So that will be also interesting because they can reveal a lot of things in those economic projections as well. And on Thursday, there will be the Bank of Japan, the European Central Bank, and the Bank of England. So it's going to be interesting to see how it unfolds because this is really the first major run of interest rate decisions and press conference since the conflict started in Iran and the private credit crisis began to accelerate in the past 2 weeks. And the problem with central bank is that they are driving by looking in the review mirror. So basically, we're seeing a lot of similarities with 2008, especially the similarities with massive oil spike that we saw in 2008 when it jumped from 70 to 140. So recently it jumped from 50, 60 to 120. So it's a little bit similar in a sense. And also there was underlying systemic rot in the economy back then, and we could be saying the same thing today. And both times official claim inflation was the main threat. So they were arguing for rate hikes just a few months before Lehman Brothers, and right now we have people from many central banks saying that they might have to hike rates as well. So it looks like they are doing exactly the same mistake again. And they were forced to do emergency cuts just a few months or a few weeks later. So it just shows you how they are really driving blind. And talking about the US economy, one of the macro data point from last week that was important to bring to your attention, if in case you missed it, was the second revision for the US gross domestic product GDP, because it came in as 0.7% annualized. And so that's insane when they tell you that the economy is booming, and yet it's very close to being negative. And it was half of what people were expecting. So all the economists and the people doing the forecast were expecting 1.4%, and they only got 50% of it, so 0.4. And that's coming from 4.4% the previous quarter. So that shows you how bad it is. And here on this graphic, you can see just the first bar is the first estimate, and then the darker orange bar is the revised second estimate. And of course, there will be a third estimate, but it's not looking good. And if you look at Canada, it can be interesting because it often acts as a canary in the coal mine for the USA. And so the Q4 GDP was actually negative, and the February job report was catastrophic. What's also interesting is that it was about the same job destruction as the US, but Canada is 10 times smaller. So that should tell you something about how the economy is collapsing in Canada. And just to give you an example, full-time jobs collapsed by 108,000. Yet the Bank of Canada continues to point as inflation as the primary threat, and they even hint at potentially having to hike despite the economy. So if you want to click on those pictures, you can get a bigger view, and then I put the link as well of where I got it every time. Part 2, the private credit doom loop escalate. So this economic deterioration is pouring gasoline on a private credit crisis. This is just no longer just an isolated issue for shadow banks. The contagion is reaching systemic institutions, and I'll explain why. First, I just wanted to show you this quick graphic because I think it was a good visual to show people how it was pretty quiet. So that's redemption. So that's people asking for their money back. And you can see that until Q4 of last year, it was okay. It was under 2% most of the time. And then it just jumped to 4.5% in Q4. And then it busted the 5% limit. And Q4 is not over yet, and it's already close to 8%. And that 5% limit is important because that's how they manage the liquidity. And so if everybody asks for the money back at the same time, they have to sell assets at a loss in distress, and that can be a domino effect. And so in the past week, we seem to be getting news about this almost every day, but there were major funds like Cliffwater who are joining BlackRock in getting their funds. So basically saying, we can only give so much money, the rest you'll have to wait. And there was another story that's probably bigger, and that was about the systemic portion I was talking about before. It's when banks like JP Morgan starting to mark down the value of collateral. This is big. This is the kind of thing that they did in 2007, 2008, and that led to the financial crisis. Because for those who are unfamiliar, when they lower the official estimated value of the assets, so in this case, software loans, That's what private credit use as a guarantee to borrow money. And so once someone does it, it's a doom loop where everybody has to do it as well. And so everybody's rushing to find collateral when this kind of thing happens. Another thing that's also systemic is that even people who say, oh, I'm not exposed to private credit or private equity, indirectly they are, because the big banks, and for example, here we have Deutsche Bank and Wells Fargo, they are heavily exposed to the private debt market. And so this is something that could really affect banks and then affect the broad economy, because if banks are in trouble or they stop lending or something like that, could really affect everybody. So that's something to keep in mind. And here, something else too, is that when you have trouble in one area of the economy, often people will have to sell assets in other areas. So that's why it can really spread like a contagion very quickly. And they can even be forced to sell good assets like gold or something else. So that's why it's a textbook doom loop. So part 3, OPEX and negative gamma, a market without breaks. So on top of this systematic risk, we are heading into OPEX with specifically a triple witching. So this is a major event that happens only 4 times a year. It's when stock options, stock index future, and stock index option all expire on the same day, the third Friday of the month before the end of the quarter. And it always brings a massive surge in trading volume. But this time it's different because it's actually in a state of negative dealer gamma, which I'm going to explain. So to put it simply, market makers, so it's the dealers who buy and sell options to provide liquidity, they are currently positioned in a way that forces them to sell when the market drops and to buy when the market rises. Usually it's the opposite. It's called gamma pinning, and it's like a shock absorber, but this time they become an accelerator of volatility. Another way to explain the negative gamma is think of it like a market without friction to slow down price that would usually make resistance and support act in a certain way that traders and investors expect. And so when they're surprised by resistance and support no longer holding, that can really create a lot of volatility. Here I put another analogy in case it helps. Imagine that you're driving on a hilly terrain with cruise control on a sunny day, dry day, and basically that's like a normal market. And with negative gamma, it's like driving on a rainy day without cruise control and with the gas pedal stuck to the floor. And so it's going to accelerate both uphill and downhill, and it's going to make the price action very extreme and unpredictable. Something else I wanted to mention quickly too is that SPY and QQQ, so NASDAQ and the SP 500, are both in confirmed downtrends. If you look at the chart, you'll see that they are basically resting on the 200-day moving average, which is the last level of support before usually basically a bear market or the end of a trend. So it's really bad. So we're going to see this week how it evolves. But so far, they have broken the 20-day, the 50-day, the 100-day moving averages. They've broken many other indicators. The market breadth is basically the participation. And so it has really collapsed in the past few weeks. Basically, it went from like 70% to 30%. So that means that most of the stocks are not participating. So what on the surface is not representing most of the stocks. So part 4, the asset class breakdown. With this systematic stress and a hot conflict in the Middle East, you would expect the different reaction from the traditional market, but it was really different. So that was kind of surprising. The first one is oil. So despite basically the largest disruption in history from what I've seen, and a disruption of 20 to 25% of the global supply through the Strait of Hormuz and things around, oil seemed to be capped under a glass ceiling. And so based on the research I've done, it seems to be potentially manipulated by a mix of sovereign nations or others selling short-term future contracts to try to keep the paper price low, and also countries releasing strategic reserve, hoping the conflict is short-lived. But as you can see on this chart, it seems like a really big risk to be draining the reserves when it's only going to provide between 9 and 20 days, depending on the calculations here. So it seems it's a really bad idea. Here on the second graphic, you can see the future contracts I was talking about before. So the orange line is the future line before the conflict. So you can see that the front month here for April was at $66 and it jumped to 103. But even a year later, it was actually lower. And now a year later, it's much higher than when we started, but still much lower than it is right now. So this shows you that the market expect that this is going to be short-lived, because that's the message that has been circulated by a government, that it's almost over, it's going to last only 4 weeks, blah, blah, blah. But I think eventually this will reprice and the whole curve will be much higher, because there's almost no way it's going to end within the next 2 weeks. And even if it did, I think people really underestimate the damage that has been done to all the infrastructure that can be rebuilt overnight. plus the confidence between trading partners is going to be really shattered. Gold and silver, another interesting reaction. You would have expected that with this conflict, they would be at all-time highs and going up, like we saw earlier this year and at the end of last year, but it's been the opposite. One thing I wanted to share is that in my previous video, I mentioned that there was a massive record outflow from the GLD ETF. And so I wasn't sure exactly what was going on. Based on what I've found since then, it seems like some major institutions might be taking physical delivery of gold bars rather than just selling. So it looks like they're selling the ETF, but really it's just like a redemption as a physical delivery. So there's no way to know for sure, but people who seem to be more expert than me in this matter seem to think that's the main reason why. And also it would check out with the price, because if there was that much of an outflow from the ETF, from actual selling pressure, the price would have likely gone down much lower. For copper, quickly, unlike gold, copper is being heavily shorted. And basically, it means that it will likely either result in a severe crash that would make the shorts very happy, or a violent short squeeze, which would make the owners happy. Quickly on Bitcoin, that was the true surprise of the past 2 weeks. When you look at most of the assets, they have gone down the positive over the past 2 weeks. And Bitcoin is one of the only assets that has been holding very well. I think most people now see, more and more people see it as a neutral asset, neutral reserve asset, and a good way to be able to move money quickly when in times of conflict and wars, it could be more difficult to use the traditional banking system. We will see it's been going up rapidly and it's going to approach the key resistance around the 80,000 level soon. So we will see if the recent rise is just a last leg up before a final capitulation, or if there's actually a floor that's starting to be under Bitcoin and now they might be starting a new bull market. We'll see. Another one that's at a decision point is the USD. I use the DXY to track it. And if you look at the chart, you'll see that it's been in the range for the past few weeks and months. And now it's at the top of the range. So is it going to break out? And that could be big trouble for most of the world and most of the assets priced in dollar. Or is it going to turn back down, which could be potentially fueling a relief rally for most of the assets? So in conclusion, the illusion of a booming economy is cracking. Protect your capital, manage risk, and do not blindly trust the narrative that everything is fine. Since this is the very first edition of my weekly update format, I would love to hear your thoughts. Did you enjoy the format? Especially this one, blog and audio. Are you looking forward to the more frequent update? You can let me know by doing one of the following. You can send me an email. You can click on the link here. That will bring you to the contact page on my website. You can leave me a like or a rating on the podcast platforms. You can leave a comment. You can share the blog or share the YouTube video or share the podcast. I see the amount of shares as well. So thank you. I hope this helped you out, and feel free to leave a comment on the video, and until next time.